Hi guys, my name is Tom and welcome to this week's video on explaining the Greek term ROHO. Over the course of weeks and months, we're going to teach different option terms, strategies, and techniques to our viewers. Our ultimate goal is to educate you about the wonderful and highly profitable world of option trading. As always, do not forget to click the link above to subscribe to this page and receive alerts when they are posted. So let's jump into this week's topic, which is explaining the Greek term ROHO. Before doing that, a quick refresher on what are Greeks. Greeks is a term used in the option market to describe the different dimensions of risk involved in taking an option position. These variables are called Greeks because they are typically associated with Greek symbols. Each risk variable is a result of the imperfect assumption or relationship of an option with an underlying variable. Traders use different Greek values such as delta, theta, gamma, and others to assess option risk and manage option portfolios. Trying to predict what will happen to the price of a single option or position involves multiple factors. Because the option price does not always appear to move in conjunction with the price of the underlying asset, it is important to understand what factors contribute to the movement in the price of the option and the effect they have. So what is ROHO? So ROHO is the rate at which the price of the derivative changes relative to the change in the risk-free rate of interest. ROHO measures the sensitivity of an option or option portfolio to change in interest rate. ROHO may also refer to aggregate risk exposure to interest rate changes that exist for a book or several option positions. For example, if an option or an option portfolio has a ROHO of 1, then every 1% increase in the interest rate, the value of the option or portfolio increases 1%. Options that are more sensitive to change in the interest rate are those that are at the money and with the longest time to expiration. So let's jump into a brokerage account and look at what ROHO looks in the option chain. Hi guys, so we've jumped into our brokerage platform. We're going to look at ROHO, or RO, or whatever how you pronounce it. We've currently got 4 other Greeks on, gamma, delta, and theta. So let's turn on the 5th most popular Greek. Oops. Right. Get that off. So what does this mean? Well, it's important to understand it because RO is the rate at which the price of the derivative changes relative to the change in risk-free rate of interest. RO measures the sensitivity of the option or option portfolio to the change of the interest rate. So if a RO has a 1, which none of these do have, Tesla has none, it's 0.7. But let's go to maybe a banking stock. Let's go to JP Morgan. So the RO's a bit decreased. So what it means is that if it has a RO of 1, for every 1% increase in interest rate, the value of the option or portfolio increases by 1%. Options that are more sensitive to change the interest rate are those that are at the money. So you can see here, at the money, more sensitive to it. So that is really understanding it. So using gamma, delta, theta, and vega and rho are all about understanding the different concepts about pricing of the premium. As I mentioned numerous times, option prices don't always move in conjunction with the underlying stock price. In learning how to use gamma, delta, theta, vega, ROHO, and all the Greeks help you a better understanding of it, especially if you get more into the complex trading strategies, trading on volatility, trading on interest rate, trading on time. Getting that understanding there is very, very important to give yourself a profitable position. So thank you so much for watching this video. If you like this content, please check out our website and please also subscribe to our YouTube channel. We'd also love to hear from you on our social media pages on Instagram, Twitter, and Facebook. Thank you so much, and we'll talk to you again soon. Thank you.